Hey, I'm Jimmy. In this video, I'm going to walk through a popular strategy called the Dogs of the Dow. So this strategy first came about in a book called Beating the Dow back in 1991, I believe. There's a link in the description below to the updated version if you're interested. Now, our question for this video is, what is the Dogs of the Dow and does the strategy work? Okay, so what is the Dogs of the Dow strategy? It's actually quite simple. So what we do is we buy the 10 highest dividend yielding stocks in the Dow Jones Industrial Average. Now, there are only 30 stocks in all of the Dow. So essentially what we're going to be doing is we're going to be buying the top third of the highest dividend yielding stocks. And here's the theory behind the strategy. So the Dow Jones Industrial Average consists of many of the world's largest companies. You may have seen some of the videos that we've done on this channel called the Dow 30 analysis, where we're analyzing all 30 stocks in the Dow Jones Industrial Average. And for me, it's been a very interesting exercise because I get to analyze many different companies in many different industries. But one thing that all these companies have in common is that they all pay a dividend. Now, they don't all pay great dividends, but they all pay a dividend. Visa, as an example, has a dividend yield of it's about 0.5%, while a company like IBM, on the other hand, has a dividend yield of over 4%. Now, it's important to remember how a dividend yield is calculated. So it's simply the dividend you get over the past year, divide that by the current price. And what you end up with is a dividend yield. So imagine that you had a stock that paid out, it cost you $10 to buy the shares and it paid out $1 in dividends. Well, you take the dollar, you divide it by 10, you end up with a 10% dividend yield. Now, this is why it's important for this strategy, because that $10 that you paid is crucial to the whole thing. So what happens if our $10 stock falls down to $5 per share? Sure, I'm being a bit extreme, it dropped by 50%, but the concept remains the same. If it fell down from $10 to $5, and since the dividend paid over the debt last year doesn't change, well, now it's $1 divided by 5, therefore you have a 20% dividend yield. So that's how you end up with, when you screen for the highest companies in the Dow, the ones that have the highest yield, what you might end up with is the companies that have fallen the most. Hence the term Dogs of the Dow. The theory is, just because the price has fallen, well, these companies are still blue chip companies and are probably safe. Now, we're not going to say that they're always safe, and we'll see some examples in a second, but that's the whole strategy. Basically, you buy the 10 highest yielding companies, assuming you're buying them cheap because the price fell. That's why the yield went up. And that goes into our portfolio. We buy them once a year and we equal weight them every year. So does it work? Well, I actually went ahead and ran a back test on the Dogs of the Dow strategy going all the way back to the year 2000. And this is what the portfolio would have looked like had we followed the rules according to the book that was written about this. It's called Beating the Dow. And sure, this looks pretty good, but the book claims that this strategy is designed to beat the actual Dow Jones Industrial Average. So this chart, this is the strategy versus the Dow Jones Industrial Average. And as you can see, it looks like the Dogs of the Dow strategy did in fact beat the Dow. But let's look a bit closer at some of the individual years, and then we'll look for some holes that the strategy may have. So this is the annual returns for the Dogs of the Dow and for the Dow Jones Index going back to 2000. And then this is how they did relative to each other. Now, these are all total return numbers. So for both the Dogs of the Dow and for the Dow Jones Index itself, we assume that all dividends get reinvested into the portfolio. I also assume that they were equal weighted at the start of each year because that's what the book said. So during this time period, well, we had 19 different time periods. And in all those years, the Dogs of the Dow lost to the Dow Jones Index 5 times. Now, this means that the Dogs of the Dow were able to beat the Dow Jones Industrial Average about 74% of the time. And frankly, this fascinated me. Is it really that simple? So I thought to myself, well, maybe it's only working because it's being compared to the Dow Jones Industrial Average and not something like the S&P 500. After all, the Dow is a price-weighted index and the S&P 500 is a market cap-weighted index. Plus, the S&P 500 has so many more companies. Well, this is what the chart looks like for the Dogs of the Dow versus the S&P 500. And it turns out that this wasn't even close. So I thought that it was really interesting, but now let's see if we could find some holes in the individual strategy. Every strategy has them, so I was curious what this one was. So if we switch back to the annual performance, well, we can see that this time period jumps out at me. In fact, I could easily make a case that this 5-year time period, we could analyze that, but 2006 was such a good year that it probably makes sense to focus on the 3-year time period. Now, to narrow it down even more, 2009 was the worst of all the years. So I figured I could jump in there and look at that specific year to see what we could identify. Okay, so these were the holdings during the 2009 holding period. And this actually brings us to the key weakness of this strategy, in my opinion. 10 stocks really isn't enough to fully diversify a portfolio. Studies have shown that somewhere between 20 and 40 companies gives enough of the benefits of diversification. So that's a risk. And I actually think that it's the biggest risk, since less companies means that you're more concentrated in each company that you own, and you're less likely to be spread out amongst more sectors. Okay, so what happened in 2009? So we know that's when the Great Recession was going on. And we know the banks were getting killed at the time. And Citigroup was down more than 50% in that year. And that really hurt the portfolio because, once again, it's a large part of the portfolio. But the biggest issue in this year was General Motors. General Motors filed for bankruptcy in 2009, and the stock was down more than 85% that year. This is a danger of having such big weightings on every holding. But the same can be true on the upside. 2003 was the best year for the dogs of the Dow. They posted up more than a 40% gain, beating the Dow Jones Index by more than 12%. And in that year, Caterpillar was up more than 80%. And since that was such a big piece of the whole portfolio, the entire portfolio did very well. So I think that that's the biggest risk and also one of the biggest benefits. I think that you're likely to get increased volatility with this type of strategy, but overall, history has proven it seems to be working. But what do you think? Do you like the dogs of the Dow portfolio? I actually got this idea for a video from a comment on another video that I had done, and that subscriber had told me that they had been implementing the dogs of the Dow strategy on their own portfolio for the past few years, and they said they've had quite a lot of success with it. So I can see how they'd have a ton of success. Look what the returns have been like over the past 5 years or so. So congrats to them on that. That's awesome. So to everyone else, have you ever tried this strategy? Is this the type of thing you would implement in your portfolio? Are there any other strategies that you've heard about or that you've tried or you want to try? Let me know what you think in the comments below. I'd be curious to make a video on other types of strategies that has a history of being successful. So if you haven't done so already, hit the subscribe button. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.